Hi, everyone. It's good to be here this afternoon. My name is Mark Baribeau. I'm head of global equity at Jennison. We're in New York and Boston. Always a pleasure to come to South Africa. We've been doing it for years. I'm going to talk about growth as we define it, what we're looking for. We invest in what we consider to be new market leaders. They usually have a unique business model. That's what's enabling their success in the marketplace. They have very strong competitive advantages because they're usually causing a structural shift in their industry. They need to defend that profits pool from a lot of competition. So it's really important that they have a significant edge on their competition. And they're usually founder led. As they mature as companies, they'll have different management will take over, and then they become more of an innovative product cycle based company. But the big disruption is over. And so when you think about our portfolio, it's going to really depend on three key catalysts for growth, the kinds of companies we're invested in. Number one, they're usually introducing something disruptive to the marketplace. Think of Tesla, Netflix, Google in the old days, Apple with the iPhone, et cetera. The list is quite long of these multi-year winners that drive not just performance for those individual companies, but eventually drive the return of the market itself because they become that big. So these are really important companies to get in early. They're not that common though. So the second most important catalyst for us are just innovative businesses. They've been around a long time, or they're young. They're not disruptive, but they keep introducing new products to the market that are very successful. Consumers love them, and they're able to sustain their growth rate at a low double-digit rate. Not dynamic, not as exciting, but very consistent. Those are also hard to find, but once you do, they can turn out to be really good performers. And then lastly, these companies all, in either category, have expanding addressable markets. They're either moving their success to a new geography on the product or service front, or they're moving into adjacent verticals where they have a high degree of competency because it's adjacent to their core competency, and it just keeps the earnings and revenue growth moving. So that's the type of business we're looking for. Over time, they do become the who's who in the market, so that's great. But they're really dynamic. And why do we fish in that pond? If you look at this chart that's up here now, and if you look at MSCI All Country World since 1997, since the inception of the index, and you just look at rolling 5-year period returns, companies that are generating the fastest growth, the top quintile of the market, generate high double-digit rates of return, high teens. It's really powerful. That second quintile also drives very good double-digit returns. Think of those more of a stable double-digit compounder like an Hermes, companies like that tend to be consumer-branded companies. You could also put Apple in that category today. Just a big consumer company. It's not really a tech company anymore. When you look at sort of the market today, there are a lot of interesting structural changes going on. There is a rapid pace of innovation. It seems to accelerate every 5 years, getting faster and faster. The most important of which is generative AI. We'll talk about that in a minute. I think it is the most important part of the market today. It's the one thing you have to get right for the next decade to be successful, we think, in the investment world, because it's going to drive a lot of major disruption across industries, but also major investment opportunities for those companies that are providing the goods and services to do that. So it's a double-edged sword there, so it's going to be very important to get right. But also you have very important things going on in global consumer brands. We prefer direct-to-consumer distribution models. You can only buy the product from them. They tend to be vertically integrated in their supply chain. They control their own destiny. And those types of companies with that unique business model are winning big versus other players. You see in emerging markets, particularly Latin America and Southeast Asia, e-commerce and fintech platforms, they usually go hand in hand because you need one to help you buy something online in markets that don't have a lot of credit card penetration. They continue to drive 30% type revenue growth. And it's early days. It's not like this is an old trade. It began many years ago, but you're finally hitting the S curve of adoption in big markets that are driving really now strong double-digit growth and franchises that can better fend off competition. And then you have healthcare innovation. It never tends to be a big part of what we do. It's always there. It's probably 10% weight or less. Healthcare has the has the worst sustainable competitive advantage in the marketplace, because if you do develop a new pharmaceutical product or biotech product, it's going to be chased by hundreds of companies. And it's very hard to defend it over time. But if you're early in an investment where there's a big new product cycle, a few years ago it was GLP-1s for type 2 diabetes and obesity, although that trade is largely over. And today it's just in specialty products where we're focused. But it's a consistent part of exposure in our portfolio, never big, but it can play a really important role because there are unique product cycles going on there. AI is the big one. A lot of questions about this in the marketplace. It's causing a lot of consternation in the marketplace for different reasons. Is the CapEx boom sustainable? Is the seemingly wave of destruction across different asset-light models an overreaction to its potential impact? A lot of questions in the marketplace. But there are ways to monetize this as an investor as you get into companies that are generating huge revenue and profit streams today. Phase one is where it's all the action's been the last few years. That's the build out of this accelerated computing infrastructure, data centers, et cetera. So it's NVIDIA GPUs, it's ASICs from other semiconductor companies like a Broadcom. There's networking companies involved. And of course, cloud-based computing platforms, because all this computation is occurring really on four companies: Amazon AWS, Microsoft's Azure, Google Cloud, and then secondarily on other smaller cloud companies. So they're all generating tons of revenue growth right now at very good margin. So you are seeing monetization of AI, but it's very narrow, but it's there. And then there's all sorts of bottlenecks that occur in this build out. Right now we have a massive memory shortage globally, so you're going to see a big capex boom in semiconductor manufacturing, which benefits a handful of companies. You also have electric power demand constraints. So again, you have lots of opportunity to invest in companies supplying the equipment to get this constraint removed. And these are multi-year build-outs. It's not 18 months, 24 months. It's going to be over the next, it's going to really be through 2032 for the power side. But phase two is the most exciting. That's what's coming this year. We're starting to see early data here. And that is pure AI applications. I'm sure everyone in this room has ChatGPT. So search is one of the big ones. So far, that's just being monetized by subscription. OpenAI is already at a $20 billion revenue run rate after 3 years. So that's as fast as Google was. Well, it's a little faster actually than Google when it started. So this is it's already a powerful monetization tool there. But you are getting AI agents hitting the market now. That's primarily coming from Anthropic and their cloud tools. It's explosive growth. I'll show that in a minute. Again, big monetization going on now. Early days. These companies are going to come public in the next few quarters, and so you're going to start to see brand new companies hit the market that are publicly traded that are going to be the disruptors, and they're going to be in the big guns like an OpenAI, ChatGPT. It's going to be Anthropic for enterprise tools, but it's also going to be all sorts of verticals like in customer service and areas like that. That's where we spend most of our research today, is on those companies, because when they hit the market, we want to get them in your portfolios. Phase three on the edge. It's already being sort of developed in conjunction with, it's not new. I mean, it's not going to be last per se. Uh, it's just easier to describe it this way. But you're going to turn your iPhone or your smartphone into a digital assistant, where it'll book things for you. You'll give it a voice command. It'll go out and do it all. Come back to you. Email the restaurant or go on the website of the restaurant for booking. Handle it. Get back to you. And ask you questions about which time you would prefer or not. That's all going to be done without you lifting a finger. And it's going to hit the market this year, next year. It's not like 3 years from now. Autonomous driving, you'll see an acceleration of development there because Gen AI can think like a human, and it's scary. And so you're no longer relying on machine learning or just learning from data patterns on how to drive a vehicle. It can now think for itself and make more intelligent decisions. So it should see a geometric rise in effectiveness. So very exciting. Obviously, the bottom part of this slide is where the real action is for the AI currently. So you have the computing, cloud computing providers, you have the infrastructure layer that's semiconductor based, the hardware, and then you have some software companies that play a critical role in securing the network because you have the data flows enormous in and out of the network onto a device. That all has to be secure. And then on the application side, as I mentioned, the big ones are coming soon. It's not going to be these old companies. Like it's very unclear whether or not a Microsoft or a ServiceNow can make this transition. You may see a company like Anthropic replace it. CapEx, very controversial because it's so big. So this year, the big four, and if you throw in Oracle, which is a much smaller number, are going to spend now $650 billion on data centers. That's up 80% from last year. So that's huge. That's just really four companies. And by the way, they account for over 85% of all global CapEx and data centers. So they're really all that matters right now. You do have it going on everywhere else, but these guys are powering it. So the good news is, if you look at the blue bars on this chart, it's all being funded from cash flow. This isn't like 1999 or 2000, where the build out of the internet was funded by a lot of debt and a lot of IPOs of sketchy companies. This is just being funded out of cash flow. That's why it's been so fast and so significant. And so I can't emphasize that enough. The speed at which this development is occurring is only possible because these companies have so much money. So it's what makes this cycle unique. I'm not saying different, but unique compared to other CapEx booms in tech. The reason they're spending so much money isn't because they have a dream. It's because they can't keep up with demand. So anyone who tells you that the money's being spent and I'm very uncertain what's going to happen, that's wrong. They're responding to sold out capacity. All of them, if you listen to their fourth quarter earnings calls, they're sold out. They can't actually grow their business any faster because they don't have the compute capacity. And the reason is the tokens, which is a unit of measurement for computing, is exploding in growth. It's growing at Google Cloud, for example. It's growing 20-fold every 12 months. So that's enormous computing. What's driving it is so far, you have the single shot chatbot. Let's say that's a 1 unit of a token. And it's a good representation of that, actually, like you doing a simple query on ChatGPT. But if you go to image generation, which you can now do, that's a 10-fold increase in tokens. If you go to simple reasoning, so you want it to actually solve a problem and think through it, that's 100-time increase in the number of tokens. And then if you want to do a 10-second video, which Sora, released by OpenAI, can do, That's a 3,000 times increase in the number of tokens. And then, of course, you go to deep research, it's huge. So the growth in tokens is what we're following closely because that's the signal of demand from the market. That's not, again, living the dream. That's what the market's telling you demand is, by thousands or if not millions of enterprises around the world and consumers. So far, well over 1 billion consumers using it. So very, very important. And that's what's driving the CapEx boom. So I'm going to end it there. I'm sure there'll be questions about this in the future panel.
Thank you.